you that you may need to borrow against, then you can do that with a whole life insurance policy. So a few different types of whole life insurance policies are pre-need. So when we talked about in module 4 or module 1 and implementing your emergency funeral plan, we were essentially talking about a pre-need policy. A pre-need policy is funded either through a trust account plan or through a whole life insurance policy. You also have funeral insurance, burial insurance, final expense. They're all the same thing, but it's a whole life policy that you're paying your whole life and you're covered your whole life. And then similar to an annuity in that, an annuity you don't necessarily pay your whole life depending on how you set it up, but you could actually, generate income from the annuity, do the same thing with a whole life policy. Now, in term life, on the other hand, whereas a whole life you are covered for your whole life, a term life policy, you're only covered for a specific term, whether that's 10 years, 15 years, 20, 30, however long you decide, you're only covered for that specific term. Now, a term life policy is actually lower, it's lower cost. Your premiums are going to be less expensive. However, those benefits of building tax-free growth in your cash value account, or seeing those tax-free benefits or tax benefits, you don't have that with the term life. So essentially, there's no cash value, there's no tax benefits, and it can be costly to renew. So once your 10-year term is up, if you want another 10-year term, well, you're 10 years older. You're 10 years unhealthy, so it's going to cost you a little bit more. But term life is considered like a pure insurance. So this is like car insurance almost. So with car insurance, you're paying premiums every month. If you get into a car wreck, then it'll pay for your car. If you don't get in a car wreck, then it's essentially a wash. They don't owe you nothing. You don't owe them nothing. You just spent that money. So different types of term insurance or term life insurance is your traditional life insurance, the 10, 20, 30 years. You have decreasing term. So the death benefit actually decreases the longer you have the term. Excuse me. And then you have all your alphabets. You have your IUL, GUL, VUL, NLUL. So we'll get into those here in a second. But those are all term policies. So you're only covered for a specific term. Once that term is up, you are no longer covered. So think of it like written insurance. So with a term policy, you're written insurance. So if something happens to me, then my family would get this death benefit. If nothing happens to me, then that money is gone. I'm paying rent. With a whole life insurance policy, you're essentially written to own, right? So you are paying your monthly premiums, and as you pay off, your whole life policy, which is essentially your paid up additions or your paid up insurance. So the more you pay into it, the more of the insurance policy you own, the more of the death benefit. And if something happens to you before you pay it completely off, or then your family would get that death benefit. Again, cash or death, unless you set it up to be both. All right, so it's like yin and yang, right? So the different types of term life insurance policies. So your traditional term, whether you want 5, 10, 20, 30 years, you are only covered for that specific amount of time. You're only covered for 30 years, or you're only covered for 10 years. So a traditional term life policy is good if you want to replace your income. Let's say you make $30,000 a year, and if something were to happen to you, you want your kids to have that income for the next 10 years. So you would get a $300,000 policy, so that if you die within that 10, 25, 30 years, then your family will get $300,000. It's also good if you want to pay off a specific debt. So, whether it's, credit cards, more, whatever it is, it's good for that as well. And if you're a business owner, say you're a business owner, you have a partner, and if something were to happen to you, then that policy would pay for your half of the business, essentially buying you out of your business with your partner. The other option is a GUL, which is a term life policy. All of these are term policies. So a GUL, or guaranteed universal life, whereas a term policy is actually going to cover you for a specific amount of time, so 10 years, 20 years, 30 years. A GUL, or guaranteed universal life policy, is going to cover you up to a specific age. So I want a term policy until I turn 90 or 100 or 120. So it's a term policy with the benefit of being or acting like a permanent policy. So you can go up to 120 years old if you like. So it's really good if you are creating a special needs trust. So maybe you have a special needs child and you don't want to lose the benefits, the state benefits that are being provided for your child. So you would set up a trust, and then the trust would be funded by the Guaranteed Universal Life Policy, or GUL. Also, if you want to leave an inheritance, or if you're protecting assets that you already have accumulated, the GUL again covers you for up until age 90, age 100, age 120. So you could, structure it so that you're covered for your entire life. Now, the NLUL, the No Lapse Universal or No Lapse Universal Life, is again a term life policy in which you are guaranteed for the first 5 years to have this coverage. So during the first 5 years, if you make the minimum payment required, you are guaranteed to have this policy. So if you die within the first 5 years, your family will get the entire death benefit. However, after that 5 years, you would essentially have to pay the entire premium. Whatever that premium is, you would have to pay it every month in order for that policy to remain active after that 5 years. We talked about the decreasing term, which is essentially you start off with a higher amount, and as you pay and as you go through your term, your death benefit actually decreases. Similar to what a mortgage does. So when you get a mortgage, you're getting a mortgage for the value of the house as it currently is. And as you pay your monthly mortgage payments, the amount that you owe on that mortgage decreases. Decreasing term, which is essentially you start off with a higher. And then we have the cashback option, which is a term life policy, whereas, with the traditional policy, you cover for 5, 10, 20, 30 years. But the difference with the CBO or cashback option is that at the end of your 30-year period, if that's what you choose, you get all your money back. 100% of all your money, of your premiums that you paid into the policy, you actually get 100% of that back tax-free. And then the last one is the IUL, so the Index Universal Life. So we see a lot of it as a lot of marketing efforts and a lot of selling of IULs, especially in our community. But in my opinion, an IUL is only beneficial for high-income earners or if you can afford to overfund the policy. If you're not a high-income owner or if you can't afford to overfund the policy, then essentially I would definitely not recommend an IUL for you or your family. So think of an IUL like a bowl of cereal, right? So with a bowl of cereal, you got your bowl and your milk. And so your milk is the term policy. So an IUL is just the term policy. So that's your term policy, is the milk. The cash value and the cash that you're putting in, that's the cereal, right? So you have this bowl of cereal, you got your milk, you got your cereal, you got your term policy, you have your cash value. So essentially, the insurance company every month will come grab a spoonful of your cereal. You know what I mean? So in the form of fees or, whether it's the monthly fees or the cost of insurance increasing. So there's a lot of fees that actually eat up your cash value if you're not overfunding the policy. So if you're not putting more cereal in, then when they come in and take a bite every month, You know what I mean? When you get down and get ready to sit down and eat your cereal, well, you don't have as much as you thought you would. So what ends up happening is that either A, you just eat the amount of cereal that you got, or you have the cash value that you got, or you end up having to put more cereal in order to offset the cereal that they've been coming in and eating every month, right? So the IUL works just like that. You know what I mean? So uh, yes, you have a term life policy. So if anything happens to you, your family would get the death benefit of the term life policy. And you're also building cash value. However, you're also losing some cash value to fees. One in particular, you're losing monthly 0.06%, I believe, every single month. So the more money you have, the more money they're going to take out. Also, the cost of insuring you is increasing every year. So that's got to come out as well. So essentially what an IUL does is take your money, purchase options on the stock market, uh, but they're not using your money though. So which is how they can, count the upside and then a zero floor. So yes, there's zero floor that you're losing to, you know, stock market fluctuation, I guess, but uh, you can actually lapse on an IUL because the fees eat up all your money. You know what I mean? So essentially, so unless you're a high income earner, you know what I mean, or unless you can afford to overfund the policy, definitely wouldn't recommend it. So a term policy, like I said, is good for a specific debt or for a certain amount of time. Maybe, I only need this term policy for 30 years because after 30 years, I'm going to make buku money and I ain't going to need it after that. Then a term policy would be good for you. Or if you have a specific debt that you want to pay off, if something were to happen to you, like a mortgage, for example, then, a term policy would be good for you. But the two that we're actually going to discuss today in the Six Figure Inheritance Masterclass are the cashback option and the decreasing term. So again, all of these are options that are available, and each one of them can be used for certain things. So the method that we're teaching here at Cindy's List, which is a little bit different than every other insurance agent or company out there, is that we're teaching you the laddering method. So the laddering method is nothing new. It's actually been around for a while. However, there's not really a push or a these marketing effort to educate the folks about this system or this new method, or in my opinion, it's a better way to insure yourself. So the laddering method is essentially taking an insurance policy and using that policy for a specific reason so that you maximize the benefits of that insurance policy. For example, in module one, we talked about your emergency funeral plan. Well, your emergency funeral plan is a pre-need policy that you set up with the funeral home. It's a whole life policy or a trust account that the funeral home sets up. That's one type of policy. Module two, we talked about the five-figure inheritance and how you can pay for those additional out-of-pocket costs, again, using a final expense policy or funeral insurance policy to offset that cost so that your family comes out of zero out of pocket. That's another type of insurance policy. And then we're going to talk about in module five, the six-figure inheritance, how to use a term policy to pay off your debts tax-free. So, different types of policies for different reasons. So, what that does for you as the owner of these policies. So, let's say you take all your money and you just buy one policy, you just get an IUL, for example. Well, if you fall on hard times and you can't afford to make that premium, then you essentially just lost your policy. I mean, sure, you can get some of that money back via, cashing it out or whatnot, but you won't get as much as you put into it. But by using the laddering method and the method that we're teaching here at Cindy's List Funeral Inheritance, if you come on hard times, it's a lot easier to, cut down one policy and lose one policy rather than losing everything because you only have one policy, if that makes sense. And plus, module one, which we showed you in the emergency funeral plan, you're paying that off in 6 months to 5 years. You know what I mean? So that's paid off. It's done. You don't have to worry about it. But module 6, we're going to talk about the CBO, the cashback option, as well as the decrease in term. So our case study for this evening is actually Alex Doe. So Alex is 30 years old. He actually has one child. His child is 15 years old. And Alex, he's been doing all right. You know what I mean? He's been working for a while now, and he has some savings. He's not really living paycheck to paycheck. You know, he has some savings. It's not a humongous amount of savings, but he's doing all right for himself. Now, he already has an insurance policy that his mother got him when he was younger. Excuse me. So, you know, his child will receive that policy because he's not going to touch it. But Alex also went through module 1 and module 2, so he's implemented his emergency funeral plan. He's implemented the funeral insurance so that his family doesn't have to come out of any extra. So he has all of this in place already. So the only thing that Alex is really worried about right now is this 30-year mortgage or this house that he has. And it's important to him that he leaves this house to his son. And because he already has his EFP, his funeral is paid for, he's already paid for the extras. His mama already got him a policy, so he's going to leave that for his son. He wants to make sure that his son has this house and that he can leave this house for his son. So now, if we use the DIME method, which is the debt, income, mortgage, and education, then if we take Alex's DIME, so let's say he's making $30,000 a year. So if something were to happen to him, we want his son to have income for the next 10 years, then that's $300,000. Okay, so the house that he purchased is worth $100,000, so he has a $100,000 mortgage. He has about $5,000 in credit card debt, and he went to trade school, and he has $50,000 in educational expenses. Or let's say he went to college, didn't finish, and still ended up with $50,000 worth of education expenses. So or debt. So if we add all of that up for the silver lining, he paid off his car, right? So so you gotta have a happy ending somewhere. So he paid off his car, car's paid for, so he doesn't have to worry about that anymore. So if we add all of that up, we're looking at $455,000 worth of debt. Now, if we go with the DIME method and $455,000, then we would get a term policy for $455,000. And if something were to happen to you during the term, your kid would have $30,000 for the next 10 years. The house would be paid off at $100,000. The credit card debt would be paid off in full. Student loan debt would be paid off in full as well. Or that's $50,000 that your child could use toward their educational expense, right? So $450,000 that Alex would have to prepare for. So the DIME method, definitely, if that's something that you want to do, by all means, please, we'll be more than happy to assist you with that. But like I said, we're actually teaching a method called the laddering method here at Cindy's List Funeral Inheritance, which allows you to maximize the benefits of each of the policies, and you have different policies for each one of the ones that you want to pay off, or each one of the scenarios that you want to cover. So let's say that already Alex is saying, all right, I don't need $455,000 because I'm gonna pay off my credit card debt in 2 years. I ain't worried about that. I don't need to make, or I don't need 10 years worth of income because my son is 15 years old and he's going to be at that point where he's going to start making his own income, right? So, he doesn't need all that. So the only thing he has left is the $100,000 30-year mortgage that he wants to make sure that he leaves to his son. So option 1 is using a decrease in term. Let's say you get a 30-year decrease in term. So like we said before, that decrease in term is going to go down as the term increases. So year 1 of a 30-year decrease in term, the death benefit would be $111,000. So that if something happens to you, your family would receive $111,000. But if let's say you die in year 15, then you won't get that 111 because the term is decreasing. So let's just say you end up with $60,000. So your family would get $60,000 if you were to die in year 15. So one of the benefits of a decreasing term policy is that you can either take the death benefit of 100,000 or 60,000, whatever it is, because it's calculated at the time of death, or you can decide to take monthly payments and use those monthly payments to pay off the mortgage payment each month. Let's say in this case it's $500 per month, and you will get that mortgage payment or that income every month for at least 2 years. Could be more, but you're going to get it for at least 2 years. So in this case, Alex would have paid $435 per year or $36 a month, and he would have paid about $13,000. So with a decreasing term, just like a traditional term, when your term is over, it's a wash. They don't owe you nothing, you don't owe them nothing, but that money's gone. You know what I mean? Now, mind you, if you die, your family get that tax benefit, or they can get that monthly benefit. You know what I mean? So, and to use it, accordingly. So that's one way to do it. So because if they use the money to pay off the house, so if it's decreasing when the mortgage is decreasing, you pay your monthly mortgage payment, then they won't necessarily need that whole 111,000 or the whole 100,000. So 60,000 should be enough to pay off the mortgage, right? Hopefully. So you're leaving the house for your family. You're leaving that six-figure inheritance for your family. So remember, it doesn't have to be money for it to be an inheritance. You're leaving the house that's worth 100,000, six-figure inheritance. That just like that. Now, option two is the cashback option. So the CDO. So in this case, he has a 30-year mortgage. So, we set it up so that he has the opportunity to pay off his mortgage 5 years early. So how do we do that? Well, we set it up as a cashback option of 25 years. So if he dies within that 25 years, then his family receives $100,000, and they can use that to pay off the mortgage, six-figure inheritance. Let's say he pays it off himself, then the family gets $100,000. So should he die within that 25 years, six-figure inheritance. Well, let's say that Alex does not die, right? So if Alex does not die, we saw with the decreasing term, that money's gone. But in this case, if Alex does not die in year 25, at the end of year 25, Alex will receive $19,000 plus cash back, tax-free, and he could use that money to pay off the remaining 5 years of the house. Now the house is paid for, six-figure inheritance. He can use that $19,000 to pay off any existing debt that he may have. Maybe he's accumulated that $5,000 has turned into $10,000 in credit card debt. He can take $10,000 of that and pay it off tax-free. He can take $15,000 and go on vacation if you want to. You know what I mean? But he's getting all that money back tax-free. So that 25 years, if he dies, his family gets $100,000, six figures, six-figure inheritance. Pay off the house, six-figure inheritance, because you got that house. We ain't even talking about how much the house is worth, right? We ain't even talking about the equity or how much it's worth now. But let's just assume let's just hypothetically it doesn't get any equity and it's still worth $100,000. Well, you're leaving a six-figure inheritance for your family through this property or through the life insurance. Either way, six figures. So now it's a little bit more expensive, but you're getting all your money back anyway, right? So if you pay $60 a month, you're gonna get your $60 back anyway. You know what I mean? So you're paying a little bit more in order to take advantage of that benefit. So, which goes back to what we were saying about the laddering method, right? And in both of these instances, though, so let's say Alex doesn't die, but he becomes critically ill or chronically ill, or he gets some terminal illness. Well, Alex can tap into that life insurance as if he had died. So let's say year 20, Alex comes down with a terminal illness, and let's say he has 6 months to live. Well, he can cash in his life insurance policy as if he had died, and his family would get $100,000. In this case, he's still living, so he would get that $100,000, for himself. Again, if he doesn't die, then at the end of year 25, he got $20,000 that he can leave to pay off his debts. You know what I mean? So six-figure inheritance for your family, just that quick, right? So if you are interested in learning more about how to implement your inheritance debt plan, if you are wanting to know how you can pay off your debt tax-free using life insurance proceeds, then give us a call. You know what I mean? You can call us at the office at 724-624-9297. You can call me directly on my cell, 832-443-6123. You can email us at info@sixfiguremasterclass.com. Definitely go out to our Facebook page and follow us at the Six Figure Inheritance Masterclass group to stay updated when the next modules will be released. But thank you all for coming. Thank you all for tuning in. Again, in this module, we talked about the six-figure inheritance and how you can pay off your debt tax-free. We showed you two ways that you could do that. One of them being a decrease in term in which it pays off your mortgage and you're leaving that house that's worth six figures to your family, so you're leaving that six-figure inheritance. We showed you the CBO option or the cash back option, where that if something were to happen to you, you get the $100,000 to pay off the mortgage, and then they get that six-figure inheritance. Or if the mortgage paid off, they had the $100,000 six-figure inheritance. Or if nothing happens, and you live past that term, then you got almost $20,000 coming back to you tax-free that you can use to pay off your debts tax-free. Yeah? So this masterclass is brought to you by Cindy's List Inheritance Protection. So definitely make sure that you go out to their website at cindyslistllc.com. That's CINDYSLIST LLC.com. And keep in mind, this is your legacy. This is your life. So thank you all for tuning in. Thank you all for being with us for the Six Figure Inheritance Masterclass. Module 4 of the Six Figure Inheritance Masterclass is part 2 of the Six Figure Inheritance. So, we showed you, how to implement your emergency funeral plan. We showed you how to pay for your extras, 0 out-of-pocket expenses for your family. We just showed you how to pay off your debt tax-free. Next week, we are actually going to show you how to leave that legacy for your family. So again, thank you for tuning in for the My Life, My Legacy Six-Figure Inheritance Masterclass, where we are showing you how to leave a six-figure inheritance for your family or favorite charity, brought to you by Cindy's List Cindy's List Inheritance Protection. My bad. You know what I mean? So thank you all for tuning in. I love you. Ain't nothing you can do about it. And if you could do something about it, I would love you anyway. All right, y'all have a good one.